Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're covering some financial results from regional insurance giant Guardian Holdings Limited, as well as its parent company, NCB Financial Group or NCBFG, for the respective first quarter results in the case of GHL, as well as the 6-month or half-year results for NCBFG. Both groups would have reported improved earnings on account of one major one-off or non-recurrent item. Let's take a look at what that would have how that would have impacted the financial results and what investors might expect in the coming months ahead. Turning firstly to GHL or Guardian Holdings Limited, well, the group would have reported an earnings per share of $3.32 for that recently concluded first quarter of 2025, a whopping 228% increase from that $1.01 reported in the prior comparable period. Now, driving this was a significant one-off gain of one of its subsidiaries. Excluding that and focusing on earnings per share from continuing operations, however, there would have been a decline from 98 cents in the first quarter of 2024 to 52 cents in this first quarter of 2025, a roughly 47% decline. Now, driving this operating performance would have been fairly stable result from its insurance service segment, declining rather 0.4% from 182 odd million to just 181 million, while net income from all activities would have been significantly impacted by first quarter volatility across global financial markets, given the tariff tantrum that would have roiled equity and bond markets in that first quarter of 2025, with net income from all activities falling from 523 million to 412 million, a roughly 21% decline. Operating profits overall declining 45% from 291 to 158 million, ultimately including the impact of that one-off sale or one-off gain from sale of a subsidiary. Profit attributable to equity holders would have improved 229% from 233.8 million to just about 769 odd million for GHL. Now, taking a look at that operating profit by segment, we can see probably a more something that's more reflective of the operating performance, of course, with LHP, the Life, Health and Pension segment, down just about 42 to 43% from 279 to 159.7 million. Property and casualty in that purplish segment up around 17 or 18% from 50.8 to 59.9 million. Insurance brokerage holding its own, and asset management declining from 13.7 odd million to 1.7 million. Fairly, well, of course, significantly impacted, of course, by that volatility in investing markets, which would have filtered through into investment portfolios and net fair value gains that would usually or would have been more significantly positive in the prior comparable period. Now, from a value perspective, notwithstanding those the one-off gain as well as the investment volatility, we can see that the book value of Guardian Holdings Limited has grown quite significantly from $17 in that first quarter of 2024 to $23.26 in that first quarter of 2025. So notwithstanding some improvement in the price of GHL over the first quarter of this year, we can see that that price to book ratio has actually declined to just about 0.7 times, which does represent, from a book value perspective, a reasonably attractive valuation for the stock for investors who do focus on the price to book metric. Of course, that would have declined from 1.8 times in that first quarter of 2023 to roughly just about half or less than half of that in terms of a ratio, suggesting relatively attractive value. So at a price of $16.51, GHL is trading at a price to earnings ratio of 5.2 times, well below the sector average of 14 times. Of course, skewed positively or in favor of GHL by that one-off gain, which will have impacted reported earnings per share positively, and it trades at with a dividend yield of 4.9%, reasonably attractive or appealing relative to the sector average of 4%. So with those modestly higher insurance revenues in mind, those relatively attractive valuations, even after discounting the impact of the one-off gain and that appealing dividend yield, Bourse is maintaining its overweight rating on GHL for the time being, with a stable outlook on the stock. Turning quickly to NCBFG, and for that half-year period ended March 2025, the group would have reported an earnings per share figure of 24 cents per share TT equivalent, an 89% increase from the 13 cents reported in that prior comparable period of HY 2024. Of course, this earnings figure would have also been positively impacted by that one-off gain in its subsidiary, which would have filtered through into NCBFG's results as well. Net income from banking and investment activities ultimately up 24% from 2.8 to 3.4 billion. Net operating income of that 24.6% from 2.7 to 3.4 billion TT equivalent. And ultimately profit attributable to equity holders up 93 odd percent from 303 million to just about 588 odd million. Taking a look at operating profit or loss by segment, we can see that in the LHP segment, where that one-off gain was recorded, there was a 50 plus odd percent increase from 812 TT million equivalent to just about 1.2 billion TT equivalent. 30% odd increase in its wealth asset management and investment banking segment from 234 to 305 million TT equivalent, and a 40% odd increase in its general insurance segment from 203 to 284 million TT equivalent as well. All else fairly similar or fairly constant across most of its other operating segments. Again, from a price to book ratio, NCBFG has managed to grow its book value from the half year of 2024 from $2.99 TT equivalent to just about $3.11, and with commensurate declines in its price. While that book value has grown, we have seen that price to book ratio has also declined 2.7 times, which does put it in relatively attractive valuation levels compared to some of its other banking comparables, of course. And when we take a look at the banking sector average of market to book or price to book ratio, we can see that the sector average is 1.3 times, with NCB at the absolute lower end of that valuation multiple at 0.7 times. Scotiabank, for comparative purposes, at the high end, trading at 2 times market to book, with the other segment constituents trading at just about 1.2 to 1.3 times. So at a price of $2.02 TT, or trading on the Trinidad and Tobago Stock Exchange, of course, NCB is trading at that price to earnings ratio of 5.2 times, below the sector average of 9.6 times, but of course it would have been impacted positively, like its subsidiary GHL, by that one-off sale, trading at a dividend yield of 3.2%, which is below the sector average of 4.6%. So with those higher banking and investment results and improved insurance service results, of course, impacted to some degree by by the earning impact of the one-off gain, attributable to or in combination with high operating expenses and those attractive price to book multiples. Bourse is maintaining its market weight rating on NCBFG for the time being with a stable outlook. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at info@boursefinancial.com. And of course, you can check out all our research absolutely free on our website, bourseinvestment.com. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy your long weekend, and we'll see you again on the Bourse Report.